Hello, fellow investors, and welcome to another episode of Ritter On Real Estate, where we teach you how to passively invest like a pro. Today, my very special guest is Whitney Elkins-Hutten. Whitney is the Director of Investor Education at passiveinvesting.com. She's a partner in 700 million in real estate, including over 5,000 residential units, more than 1,400 self-storage units across 8 states, and has experience in flipping over $3 million in residential real estate. So quite the experience, Whitney. Thank you so much for coming on today and joining us on the show.
Yeah, my pleasure. Thanks so much for having me.
Yeah. So, a lot I want to talk about today. I think I want to cover, you focus on investor education. So I want to hear from you. What are people asking about? What are people concerned about? What are you telling people? How are you educating them, right? I think there's a lot of good stuff to dig into with all the different craziness that's going on right now. But before we get there, start at the top. Tell us a little bit more about who you are and how you got to be where you are today.
Yeah, definitely. Well, I'm the Director of Investor Education here at passiveinvesting.com. I did not start there. I actually don't have a degree in real estate. I started off in real estate investing in 2002 as an accidental landlord. I bought a house with a significant other, and about a month later, the relationship fell apart. And here I had a house, all the bills associated with it, and it needed a massive rehab. And back then YouTube didn't exist, so I learned how to do this all myself from reading books, specifically the Home Depot 1-2-3 book. And 11 months later, I was able to sell the house, which was probably my number one investing mistake, and made more money in my day job and had eliminated my housing bill and had been making money every month. I didn't realize that. But once I sold that house, I was bitten by the real estate bug and was like, how many more of these can I do? I eventually figured out that I needed to hold on to property as opposed to flip it in order to kind of unlock those golden handcuffs and, free myself from a paycheck dependence, and also from, create financial freedom for myself. And my husband at that point in time had joined my antics, and so we were doing fix and flips, both here, buy and holds here locally, and then also out of state. We were rehabbing property out of state as well, just to keep our capital growing. And we had a baby girl, and we had, I was taking care of family members. And at that point in time, I was like, okay, we need to learn how to scale faster and passively. And so we decided to go into multifamily investing actively ourselves to kind of kick the tires and try it out. But also I started diversifying our portfolio into multifamily self-storage investments, and then tons of other stuff within residential and commercial real estate. But fast forward today, we actually have 6,300 units under residential units under management, and then probably closer to 2,000 self-storage units. And but the most important thing here is that those are all vanity metrics. I mean, what the result is, what people are after and what they're trying to copy, is that we've been able to create financial freedom for ourselves, freedom of choice on how we spend our time, freedom of location independence, and then freedom on how we want to create an impact in the world.
Mm-hmm.
That's what I love about my work here at passiveinvesting.com. I spent many years as a director of investor relations and operations for a private equity group, and with my role here at passiveinvesting.com, I get to focus on what are those behaviors and what is the knowledge gaps that investors have to move them into action. And so I don't have to walk that fine line of educating and sales. I just get to focus on the investor and what their needs are.
Yeah, that's really unique. And I'm sure you provide a lot of value in that role. So yeah, so those are some of the things I want to ask you about. So you spend all day talking with investors, right? Or potential investors, educating investors. You mentioned knowledge gaps. So what, in your role with all this experience investing yourself, all these conversations you've had with investors, what are those big knowledge gaps that prevent people from making what otherwise might be a good investment decision.
Well, it depends on where the investor is in their journey. So, maybe it's somebody who's just starting out and they have somebody mentioned passive investing and they don't even know how to really invest correctly in the stock market. And so really just kind of educating them on what passive investing is, why real estate is such an amazing vehicle for creating cash flow, protecting, capital preservation, creating equity, generating tax benefits, how you can get, amplify returns through smart use of leverage. Not all leverage is smart, but smart use of leverage. And then also leveraging an operator's, time, knowledge, expertise, and team to grow your wealth. So that's really, one camp. The person who like just is new, kind of like doesn't understand, what this world really is. Another camp is somebody who is has a few properties under their belt, maybe a couple, small multifamily or some single families, and they've been their own operator and helping them transition. Maybe they want to fire their property management. Maybe they want to fire Home Depot and Lowe's and just really like get rid of the thorn in their side with their property. And so there I help them understand how you can, amplify leverage through investing in the operating business that holds real estate, and move them from looking at deal chasing yield, and helping them understand how to evaluate an operator in the market, in the deal, so they can smartly make that transition. And the third camp, and there's two more camps. The third camp is the professional investor. They're coming on the stock market. They know they're seeking alpha. they're really highly knowledgeable about investing. Yeah. And really for them, it's orienting them away from, those paper securities into something that's backed by a hard asset. And then the last camp right now, especially in the past like 6 months, is really like helping people orient around how to invest when without fear. Inflation's high, recessions. It talks of a recession either looming or here or coming. Like, where are we? Like, how do you kind of not pick apart the knowledge and all the numbers and find out what's real, but really how do you kind of like set that noise aside and say, hey, if I invest on basic principle and learn how to mitigate risk through investing in a passive asset with the right operators in the right markets and the right deals, recession, inflation, that's all becomes noise. And so that's really where I'm spending a lot of my time today, is really helping people, stop being in the trap of reading headlines and being in fear and sitting on the sideline and, creating this opportunity cost drag in their portfolio, but really like, cutting through that noise and understanding what the real principles are behind investing in passive real estate, residential and commercial.
Yeah, I love that. I mean, I think that's a mission that drives many of us, right? Is help people get into those investments. They're going to improve their financial future, right? So a lot of value you're bringing there and helping people get on the other side of the fence and have confidence making that decision. I'm curious, as you break it down, you mentioned, I think, 4 groups. How would you segment, like, what's the percentage in each group? How many
Well, that
people?
that fourth group, actually, that fear overruns all the other 3, right? So that's kind of like an extra layer that gets thrown on. As far as, our particular investing base here at passiveinvesting.com, we're dealing primarily with the accredited investor. So usually we're dealing with the latter 2 camps. So somebody who already has their own property, has built up sizable wealth with their own single family, small multifamily, maybe their own business, and they're looking to transition that into a passive investment. Or somebody who is just a really highly educated, high income earner, very smart investor already, really understands everything. I would say primarily 40% in those in each of those last two buckets. And
Yeah.
then, smaller camp in the first bucket. We definitely get some new investors, but they probably have a translatable skill that they don't realize they have. And that's sometimes really fun to kind of figure out. I hop on the phone with them and they go, I know nothing about syndications and group investing. And I'm like, well, have you owned your primary house? Have you bought a rental before? Have you run a business before? And they're like, well, yeah. And I'm like, okay, let's start connecting the dots so this doesn't seem so scary and elusive for you.
Yeah, I love that. I love relating it back to things that are already familiar to them because you get past that uncertainty and it gets past a lot of that fear. So
Well, it's so
very
funny.
good.
Like, I remember whenever I, read my first prospectus, like, a stocks, bond, and mutual fund prospectus, and I'm like, what language is this? I,
Yeah.
I'm like, I know two languages, and I'm like, I can't read this. And then whenever I started like listening to podcasts and reading, I'm like, well, why didn't they just say that it's this? Like, why do we have to change the words? And that kind of goes with real estate investing. Like, why do we have to like change it from profit to net operating income? Like,
Mhm.
it's
Mhm.
really kind of tying it back to things that they actually already do know.
Yeah.
So it doesn't seem as like out there.
Yeah. Yeah, I love that. I love that. So you mentioned, 3 groups, kind of that 4th group. I mean, that's where I want to hone in on because I feel like it's what a lot of us are facing right now is this what I call FUD, right? Fear, uncertainty, doubt. You read the headlines, everything is bad everywhere all the time,
Mhm.
right? There's a lot of things moving, a lot of inflation, interest rates, all these things, right? So what are the main concerns that you're hearing from the people in that 4th group, no matter where they are? And well, let's just start there. Yeah, what are the main concerns that you're hearing?
Yeah, well, they want to understand how to beat inflation, right? That might be one major concern. Like inflation's high, it's at 40-year highs. We topped out at 9.1%, I believe, in July, and I think they just released the numbers. We're down to like somewhere like 7.23 right now for the end of August, early
Mhm.
September. How do I beat inflation? How do I play this game? Um, they're looking at the fear of like the Fed raising interest rates, and they naturally assume that every time the Fed raises interest rates, that has not been accounted for in all types of loan rates and mortgage rates. So there's fear there. Like, what happens if the rate continues to go higher? Like, what does that do to the investment? What happens in a recession? What happens if all of a sudden there's, and I think the recession is the kind of, we've been talking about it for, I feel like, since March 2020, like post COVID,
Yeah,
during
long
COVID,
time. Mhm.
like, and we've popped in and popped out of it. And, what happens there? I think everybody kind of equates it back, when we say recession, back to 2008, 2009, 2011.
Mhm.
That was
Mhm.
more real estate driven. There's a lot of fear and anxiety around that. And really what I like helping people do is kind of cut through the noise that those are all real. Okay, they're all real risk in the environment, but how have people made money throughout all those times? I love the quote by Nathan Rothschild, back in the 1800s, buy when there's blood in the streets. And that's usually where most people hear stop, right? Like they don't hear the other half of what he said. The other half of what he said is like, even when the blood is your own, and so that is where you have to, I think there's been a disservice to, the population at large, especially people that are wanting to be savvy investors, is that you have to learn how to invest even during choppy waters. And that means you have to learn to invest based on principle, not necessarily chasing yield and what's the next cool crypto coin that's going to come out and
Mhm.
next hot, stock tip or whatever. But what are those base hits that if you can just continue to repeat over time, very boring, and then put time on your side, like holding real estate, um, you know, that's how people make money. right? In nearly
Yeah.
any sort of environment. And so if I can, I'll go over those principles at a very high level, and then we can kind of dive down the rabbit holes if we want. But capital preservation right now, looking at, any investment you're going into, making sure that it's an asset backed by something hard. Real estate, a well-run business, okay, very well-run business, that there's ample reserves on hand to support that asset, so you don't actually have to sell it during, down times. That your operational costs to run that asset or run that business are low, so you've got a healthy margin to work with there. Those are all the things that are going to help you preserve capital. Cash flow, making sure that the asset, especially in real estate, cash flows today. Okay. There's an element of stabilization today, that you're not waiting 9, 12, 18 months for your cash flow. Now, for those type of growth momentum investments, more focused on equity, there's a time and a place that an investor should do that. But that's not the first investment somebody should go in. That should not be their first investment. So making sure that there's cash flow. Then
And what
equity.
are, sorry, just cash flow wise, so like what are expectations investors should be expecting right now for cash flow? 'Cause I think that's one of the things I've seen be most impacted
Yeah.
in all the change that's going on.
Well, I think that's where the greatest opportunity is, for people to look at different types of asset classes within real estate and commercial real estate. Because they all cycle differently, right? We've seen a huge cap rate compression in the past couple of years with multifamily real estate. Cash flows can be thin. Now,
Mhm.
now there's ways that operators can amplify their cash flow by using riskier lending, terms on the asset, like floating rate debt. There's a lot of things there. We can pick that apart if we want to, but making sure that the asset works really well with the current lending terms. As far as expectations, I think this is where people need to understand that getting an asset that has 10, 12, 15, 13% preferred returns right out of the gate, it probably has a very high element of risk to it, especially like on a multifamily asset. And so that cash flow can be an indication of risk with the loan or a risk with the business plan. And
Mhm.
so we're looking at assets. Our most recent multifamily asset, our year one cash flows are 5.1%. We have a 7% preferred return, to help protect investors, getting the 7% of any deal, any part of the deal. But just level set expectations. We're trying to, help the investor understand that the cash flows are right now lower. Now, for example, on our car wash deals, in that space, that's an operating business. We have more levers to pull there to amplify cash flows. So cash flows are higher. And we can eliminate reduce the risk in other ways to protect that cash flow. So, so I guess what I'm trying to say, to put a little bow on it, somebody who's just like, I'm a multifamily investor, that's all I'm going to do. Things have cycled, right? And so cash flows are probably pulling down right now. Now, eventually they'll cycle back up as rents catch back up with the higher asset prices. But that's not what today's environment is. You might need to look at different asset classes if you want to amplify your cash flow.
Gotcha. Gotcha. Yeah, and different asset classes, I think obviously there's a good mix, right, is what makes up a complete portfolio. But as we think about multifamily, it sounds like lower cash flows on the front end. Pref maybe hasn't really changed. So pref kind of just being accrued until we're able to catch up. Is that the model? Is that how the plan works?
Well, and that's what we're doing. That's how we're showing investors. We want to make sure that they're well oriented to what's actually happening on the project.
Mhm.
One question for an investor, if you see somebody's project who the year one cash flows are actually at the pref level is, to take a look at the underwriting and see if that's actually what's underwritten the model, or if the operator is distributing back cash flow to them to get them to the pref.
Yeah,
That can
that
be a
is a
bit
great
of
question to ask.
that is a bit of a marketing strategy. So I've talked to investors on the phone. They were like, I've talked to this other operator and they actually do 7% in cash. And I'm like, that's
Yeah.
really odd that year one hits 7%. Like,
Yeah. 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 Well, I think that's where education is so important, right? It's where
Mhm.
education is so important. So absolutely, I think, um, the high integrity approach is to just be transparent and distribute from the operating, profits of the business. So I think that's where education is important just to understand. But your point about asset classes and different asset classes and different cash flows, I think is really important in helping investors understand, um, based on their goals, which asset class is right for them, right? Multifamily is good
Absolutely.
for some. Maybe there's you guys are doing storage and car washes, and those all have values, right, in different ways. Um, and so I think that's another great education point. So as we step back out, I know you were kind of going through your pillars as I took us on a detour. I'd like to continue through those pillars and understand what the rest of those items are that you're really focusing investors on.
Yeah, well, and I think it plays very well to, speaks very well to what you were saying about the different asset classes and what investors need, right? Because as we work through these pillars, one person is going to be, need capital preservation. Another person is going to need cash flow.
Mhm,
The third pillar is equity growth, right? Looking for assets that have, um, you know, not just, are in growth markets or in the path of progress and have some sort of natural appreciation, but is there a way to create forced appreciation on the asset
mhm.
through increasing income, decreasing expenses, and adding additional streams of income? Now, one thing that we've done is that we've looked at de-risking the risk around labor right now, and supply chain disruption, and really have kind of looked for those projects that don't have a whole lot of capex and deferred maintenance to them right now. Those tend to be your more B plus class A
Mhm.
suburban assets. So that would be a pillar, would be equity growth. And then, one of the fourth pillars, the fourth pillar I look for is tax benefits. And that's one of the wonderful things about real estate. Helping people understand the use of depreciation, bonus depreciation. This is the last year for 100% bonus depreciation. It'll start ticking down after this year. We still have a gift, right? Like before 2017, we were at 50% bonus depreciation. So we still
Mhm.
have a gift here for a couple more years where we're well above 50% bonus depreciation. How is cost segregation analysis used to accelerate depreciation to the early years of the hold? How can you leverage 1031 exchanges to keep your gains and your depreciation recapture and kick that tax can down the road?
Yeah.
Um, make sure that's a pillar in the transactions that I'm going into. And then, past that, smart use of leverage. You know, I, I'm personally leery of, you know, bridge debt right now, a floating rate bridge debt, things that don't have that are debt that doesn't actually last for the term of the business hold. I think you're creating a lot of interest rate risk with the asset. Um, how much of a leverage or excuse me inflation hedge can you create? Can you move your rents like on an annual basis, a monthly basis in the case of self-storage, weekly or daily basis in the case of car washes and hotels? And then, the last pillar is if you're going to invest passively, it has to be with an operator that you know, love, and trust, and has the track record and the experience, and the ability to execute in this environment. They have to have
Mhm.
the business knowledge, and somebody on their team has to have the real estate experience and the real estate knowledge to do this.
Yeah, absolutely. So those are fantastic pillars. I appreciate you breaking that down. And I think that's, like you said, you get past the headline metrics to what are the core things that really drive value in these deals. And so as you think about I guess as you think about these conversations that you're having and thinking about where people where people are going. I mean, what are you seeing as you're having these conversations? I mean, what's really resonating with folks as you're talking about them related to maybe certain asset classes or certain strategies? And what's the feedback that you're getting?
I think that really going back to the root question of what their goals are, right? It's interesting, yeah, I love this quote. I learned it years ago. Fear is just excitement in need of an attitude adjustment. And so when you have
Mhm.
somebody that you're talking to that is so fearful of like, what about this and what about that? Bringing them back down to like, well, what are your goals? What are your needs? Like, what do you need your portfolio to do? Because, really their fear is what happens if this investment does not fulfill my expectations or meet my expectations that I need in my portfolio? So if
Mhm.
you can just kind of like take it this from fear and turn them back to focus on their goals, now it becomes a much easier conversation. I'm not combating what's in the headlines or what Jerome Powell did or anything like that. Now
Right.
I have them looking at their portfolio going, well, I need to do this, 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 and this in the next like 10 to 15 years. Fantastic. Here are the, multifamily has a balanced approach. I'm just kind of like coming off the cuff with an answer, between
Yeah.
cash flow and appreciation, and tax benefits. Maybe this is a good fit for you. Or
Mhm.
somebody's like, I need high cash flow like right now, and I'm willing to hold, do a 5 to 10 year hold and wait for an IPO. Well, maybe car washes is a great investment for you. So, really just kind of listening and so first step, reorienting them back to their goals, getting them off this whole like fear and the FUD, as you put
Right.
it. I love the
Right.
acronym. I'm going to use that. But I would maybe switch out that D for distraction, right? That's what all these headlines are doing. They're distracting them from their goals and then
Sure.
reorienting them to their goals and then offering them something that will help them meet their goals.
Yeah. Yeah, I love that. So I mean, essentially bringing us back to one, a longer term view, right? I mean, 10, 15 years from now, where do you need to be? Where do you want to be? And what's going to facilitate you to get there, right? And those break down to their goals. And if you can do that and you can show them, at the end of the day, if we look past what's going to happen over the next year and next 2 years, like you said, looking at assets that have hard assets that have, a physical asset behind them, right? Not just paper, that through history has appreciated over time, right? If it's going to provide, because I like what you said about, the fear is that it's not going to meet their expectations, right? And so if their expectation, or even if the deal says, well, it's going to be, whatever, let's just say 10 average cash on cash, right? But in reality, looking at their portfolio, maybe they only need 5 or 6 or 7 to meet their goals and do what they want to do. Then I think that shows a level of cushion there too, right? That maybe helps alleviate that fear. So I think that long-term focus, getting back to their goals, um, really good work you're doing to help people get over the fence and make that investment that I think, as we both have personally understood, is going to ultimately improve their financial performance. I mean, for nothing else, whether you mentioned alpha earlier, maybe it's not that alpha, that additional return, but it's de-risking through diversification, right? Which is kind of I think the value that everybody can benefit from.
Absolutely. Well, and also I was putting together an article and going through a lot of these principles. Oh, actually, sorry, the article was over money principles for kids.
Mhm.
And what do you need to teach your I have a 10-year-old, so I was going backwards and like, what did we start teaching her when she was 3? We were playing
Yeah.
cash flow for kids when she was 3. So um it was about capital preservation. It was about cash flow. It was about
Mhm.
providing, value, like in the form of growth. Like you had to learn how to grow a business or grow your real estate. And I mean, the game, it's very simple, and it's teaching the child at 3 how to do this. More importantly, what's the difference between an asset and a liability? That kept me buying tons of
Mhm.
our Barbie dolls at like
Mhm.
Target.
Mhm.
So, but when I was putting this together, you can laugh at that. That's fun.
That's
But
hilarious.
when I was putting this together, you have to like, you have to teach the principles, but you also have to allow time to work. And
Yeah.
that is, when you look at Warren Buffett, when you look at Ray Dalio, like when did they make majority of their money? It was like in their 60s and after.
Absolutely.
So if you're starting right now as a passive investor in your 30s, like I mean, that's amazing. It's just, you gotta like set the principles kind of, I don't want to say set it and forget it. I never want anybody forgetting their portfolio, but make it very boring and then let time work for you, because
Right.
you know you can double in 5 years. That's very realistic. A lot of us saw a doubling in 3 years, with the run up in asset prices during the pandemic. Okay, that's not going to continue to happen. If you can beat 7 with the market, and that's on a good day, good
Yep.
decade, even better, right? So that's the
Absolutely.
other component is just, how can you be kind of a boring investor and allow time to work for you?
Yeah, right. We've got a lot of excitement in a lot of places in our lives. It shouldn't be in our investment portfolio. And yeah, Whitney, I think that's an awesome place to wrap things up. I think you provided a ton of value, some good pillars, some insights into how to get past the FUD, right? Which is the new acronym. And so, yeah, I think that I appreciate you sharing so much of your insights. Before I let you go, I want to take you through our keys to success round. 4
Let's
questions I
do
want to
it.
ask you. First one is, if you were going to invest in someone else's deal and you could only ask them one question, what would that one question be?
Ooh. Uh, I Where does your investment meet my 7 principles that I live on this checklist?
There you go.
I would fudge a little.
Your 7 principles. I like it. What are you most proud of in your career?
Um, I think my personal growth, and I don't mean necessarily like the growth of our portfolio, but just who do I had to become in order to achieve the things that I did. I never thought that I would ever be here, like mentally, emotionally, spiritually and financially. So, but yeah, just just who do you have to become in order to meet those challenges?
I love that growth. What book should everybody read?
I think there's 2 books. If you're talking like about real estate, I think, really to lock in those concepts of how do you invest in an operating business like passive real estate, really going back to the cash flow quadrant. I know everybody says Rich Dad, Poor Dad by Robert Kiyosaki. I love the cash flow quadrant because it really helps people understand, how do I achieve true financial freedom and time freedom? Um, and then 2, like, you've got a lot of work ahead of you to do this. And I love the book, The One Thing by Gary Keller and Jay
Mhm.
Papasan.
Yeah, both amazing books. I just got done reading The One Thing, again, listened to it on audiobook while I was at the gym, and, every time I listen to read that book, it's amazing. You take away something, just kind of a refocusing, which I think is extremely helpful, especially with all that we have going on in our crazy lives. So, yeah, love those
Um,
books, both of them.
we do
La
the couples goal setting retreat every November, and
Yeah.
it's um, where you're like learning how to put the one thing into practice between, like, I have a husband, like,
Mhm.
together as a family, or
Yeah.
you can do it with the business partners and stuff like that. Like, how do you kind of like dovetail these priorities and values together? And I always love it that I'm learning so much more about myself and then also my partner at the same time.
Mhm.
So I'm like, last year I was like, wow, that's what it is. That's what your value is. Like, I always thought it was like laziness. No, it's leisure. And like now I know that, I'm like, oh, Oh, he's not being I know. I just said that on a podcast. Sorry, guys. I can laugh at myself, but
Hopefully he's
he
not
knows that.
listening.
But yeah,
Is
it was
that so is that retreat something that, put on by Gary Keller and them, or is it through somebody else?
yeah, so you can go to the onething.com, and I think one is the number one.
Gotcha.
And they have a couples goal setting retreat. The beautiful thing is with COVID, they learned how to do it online. And so
Yeah.
you can, join it in person. I don't know if they still have tickets, but you can also do it remotely from your house. You
Oh,
just
very
have to block
cool.
out time to get it done. It's amazing.
Very cool. Well, awesome. Appreciate that tip. And then last but not least, what is your number one key to success?
Tenacity. I grew up kind of like being a recovering perfectionist. Like, I hated the word no. It's just like, how can I like just not knock the socks off of somebody, from the very get-go. But I had to like learn how to fail fast and fail forward and just have the tenacity to continue to like, try again.
Yeah.
But just really kind of ditch that perfectionism that can, it can rob you like energetically, but it can also rob your time because you're not like testing and adjusting as quickly as you should be.
Yeah. I love that. All great answers. All great answers. Well, Whitney, thank you so much for coming on the show. If people want to learn more about what you're doing, passiveinvesting.com is doing, how can they get a hold of you?
Yeah, definitely. The best place to get a hold of me would go to passiveinvestingwithwhitney.com. It's a sub page on the passiveinvesting.com website. But there, I've got some free goodies for you. I've got an ebook on passive investing made simple. You also can see our open deals and get scheduled time with me. We can jump on the phone and talk real estate.
Awesome. We'll make sure that's all linked up below so folks can reach out to you. And Whitney, thank you. And I hope you have a great rest of the day.
You too. Thank you so much, Ken. This has been amazing.